Okay, welcome everybody to episode 81 of the Volatility Barometer. Had a little bit of technical difficulties. I'll explain in a minute why, but one thing that I wanted to try to attempt to do, and I've mentioned this a few times recently, is I would like to try to speed up the live streams a little bit, kind of get the pacing going. People have mentioned that I can tend to ramble a little bit, so I've also got probably over 100 topics on my to-do list, so I really do have to start cranking these out. So what we're going to do is typically I will do 2 or 3 segments and then we'll do the live Q&A. Right now I'm just going to do the next 4 or 5 live streams. We're just going to go down to 1 or 2 segments and I'll get through those really quickly and then we'll get right into the Q&A. And of course I can do maybe more live streams, a little bit shorter, and that will also serve as somewhat office hours for VTS community members. But of course live streams are free to everybody outside the community as well. But let's get right into it. I'm going to go into a submitted question today. It's actually been quite a while since the market has been down. So I tried to pick a topic that might, combine volatility metrics with market timing. So I think people will appreciate we're going to talk about the VIX and why it's actually a pretty terrible indicator. So let's do that. And you can go ahead and start submitting your questions and I will get to those as well. Okay, so the question is from Ramesh. How can I use the VIX Index to know when the market is going to crash? So this is a really good question, and of course the financial media will always refer to the VIX as the fear index. So it seems to make sense that, well, if this is a good fear index, then I can actually use that to know when to cycle out of my aggressive positions, right? Well, let me explain why relying on the VIX is probably not going to work out very well for people. Okay, so right here we are looking at the S&P 500. This is a 6-month chart. So clearly the S&P has been doing very well. Hopefully everybody's been riding this and making some profit, but we can see here the stock market has actually started to show some weakness. If we check out one of the charts that I've been tracking for everybody, this is showing the longest S&P 500 streaks without a 5% correction. So you can see going back through history, there's actually been some pretty long streaks, 404 days. Right now, at the very bottom, this streak we're on now, it hasn't quite cracked the top 20 yet. 118 days, we're down about 4.4%. We'll see if it can hang on another 5 days and actually make the list. But if we're talking about volatility trading, let's pull up the SVXY. This is one of the volatility ETFs that our tactical volatility strategy uses. And in this case, it's actually down about 8% recently. So when you're watching my videos and live streams, I'm always talking about using volatility metrics to harvest the best times to be holding these ETFs. This is essentially how our strategies work. This is the tactical volatility, for example. And during stable markets, when volatility is relatively calm, there's no reason why we wouldn't be net long equities and net short volatility. But if volatility starts to elevate, we do have to move into safety positions. And in this case, it will be gold. And then if volatility really starts spiking up, that's when we can try to capitalize on an all-out market crash. But this threshold, when you move from short volatility into a safety position, we actually need volatility metrics to tell us when to do that. And this is where we get to the heart of the question, is the VIX index going to be good enough for that? So again, if we're looking at this SVXY, it's down 8%. Hopefully we would have cycled out into safety by now, right? You don't want to actually just ride this thing down 8 or 10 or even 15% without exiting. So our strategy got into this trade all the way back here in November 1st of last year. We've been riding the short vol long equities train for quite a while. We've actually even been doing it with a little bit of leverage, 2 times the NASDAQ as well. So we're doing quite well. But certainly this recent weakness, we would have wanted to exit some positions. So if we actually look at my strategy, I will try to keep the clicking to a minimum here, but my spreadsheets are pretty big, as you know. Here's our volatility strategy, and we can see we exited to gold right there on April 8th. So if we try to map out where that is on this chart, April 8th is right there on that day. So this is the day we cycled out into safety. It's definitely okay to ride down a little bit, 3, 4, 5%. That's part of the process. But like I said, once you start approaching double digits and going beyond that, you certainly want to cycle out into safety. So we cycled out right there on April 8th, and we moved into gold. So April 8th for the gold trade is actually right there. So this has worked out really well for us. We cycled out of our aggressive short vol position and into our safety gold. We avoided 4 or 5% of the short vol losses, and we've gained actually some more profit on this gold trade. Now, it doesn't always work out this well. Trading is trading. Sometimes the safety positions take a few days to kick in, but in this case, it's actually worked out quite brilliantly. But more to the point, the SVXY, you need to cycle out. So what I want to show you now, if I go to some volatility metrics, and we just use some of them as an example, volatility dashboard, where are you? Let's actually check out the VIX. Again, apologies for the scrolling. I will try to find these as quick as possible to ease up on your eyes. So here we are right here. You can see this is the current date. This is going to be as of the 17th of April. Now, if you're using the VIX Index, these are the VIX Index values. These are the percentiles, and essentially what a percentile is, this is where the current value ranks in comparison to all the previous values going through history. So the higher the percentile rank, the higher the VIX is relative to all of its previous values. Using absolute numbers is never meaningful, but using percentiles is how you actually system rank things. Another thing that I've always said is when you're shorting volatility, of course you have to find some type of threshold where you're going to move from short vol into safety. And all of our strategies are different. That's what a diversified portfolio means. But in general, if you just want to have some type of baseline approximation, I've always said 65% is about right. If you're short volatility 2/3 of the time and you're in safety 1/3 of the time, you're probably going to do pretty well. So the question is, when did the VIX Index signal that we should be moving into safety? Well, that would be around the 66th percentile. So you can see it was low for a while. It didn't actually start climbing until very recently, and at no time yet has it gone over 66th percentile. So if you were just using the VIX Index as your filtering signal, you are still short volatility waiting for it to get you out into safety. This 8% drawdown, it's still not good enough. The market has to go down even more than it already has in order to just enter your safety positions. I mean, forget about the long volatility positions. Using the VIX, that would take you forever. You'd probably miss almost the entire market crash waiting for that to happen. But this threshold moving from short vol into safety, you're actually still waiting for that to happen if you're using the VIX Index. So let's check out a couple of the other indicators that I've already started talking about in this new course I'm building. Remember, I'm going through all these volatility metrics that I track with individual videos for each of them. So shameless plug, now would be a good time to claim your free trial to VTS. I'll leave a link for that below. But let's find one of these. I did a recent video talking about the VX30 to VIX roll yield, so let's just use that one. Again, the absolute values are not overly important. We're looking at percentile rankings here. But for this specific metric, the higher the roll yield, the better that is for the short volatility trade. So you can see up here, we've got those higher values. That signals that you would still be in the short vol trade. But the question is, when would it have gone below about 35% and signaled something risky on the market? Well, you can see the first one is right there. And then it went up a bit, and then it's actually been pretty consistently low, signaling that this is trouble. So when did this final signal happen? Well, this one, if we go back to the date, this is April 4th. So using the VX30 to VIX roll yield, April 4th is right there. That's when this volatility metric picked up on something and said, look, it's a little bit too risky, you might want to move to safety. VX30 to VIX roll yield is far more sensitive to volatility spikes. The VIX people, they're still waiting. They've ridden the whole thing down. The people that understand the VIX futures and the roll yield, they've exited to safety over a week ago. We're just watching with popcorn in our hands, waiting to see if the actual stock market is going to fall out here. Another thing that I've been talking quite a bit about on Twitter lately is the VIX to VIX 3M ratio. So let's find that. Again, apologies for the scrolling. VIX to VIX 3M ratio. Let's see how this one's going to do. Again, don't worry so much about the absolute values. This is just for my internal calculations. But here's the general percentiles. And we're talking about the same thing here. It's just actually opposite now. The lower this percentile, the better it is for the short volatility trade. And the higher the percentile, the more risk it is signaling in the market. If you want an extremely quick explanation for what we're talking about, this is coming from our daily email. This is the cash VIX term structure. So here's the VIX index that everybody knows, the 30-day VIX. But there is also VIX-style calculations for 9-day, 3-month, 6-month, and 1 year. So the VIX to VIX 3M ratio, you can see it here. It's essentially measuring the relationship between the 1-month VIX and the 3-month VIX. Under normal stable conditions, the 1-month VIX should be lower and the 3-month should be higher. This represents near term, not a whole lot of fear, but further out, there's more uncertainty, there's more time that could pass, more things could happen, and so this should be priced higher. But the closer these get, the higher that percentile gets, and you can see right now it's the 80th percentile, clearly signaling that we should be in safety. But you can see, again, if we're checking the dates that it was starting to signal this, the first time it went over the 65th percentile is here, dipped below a little bit, but you can see these are elevated readings. And again, where did it start to give you those warning signals? That's again on April 4th. Now, for me personally, I will also highlight when I'm using my volatility barometer, like I said up here, this is all my top volatility metrics combined into a single index. It's actually using 13 different volatility metrics right now to come up with this overall index. The reason we do that is because sometimes the signals don't completely agree with each other. So you're using a combination of many different things, and then you get a much more robust signal. But again, if you're using that VIX to VIX 3M ratio, you're talking about getting the signal somewhere around here. That's where you would have wanted it to happen. If you're going to be trying to profit from the short vol trade, most of that growth should be coming from the short vol allocations. But the truth is, just based on the structure of volatility ETFs themselves and the market overall, pretty much anybody can short volatility and make money about 70 or 80% of the time. That's not the difficult part. The determining factor, whether you're going to have a couple of years of success or a couple of decades of success, is how successfully you can exit to safety and avoid those massive crashes. And then, of course, throwing in a little bit of market crash profit, that would be nice as well. But that's how you construct a short volatility strategy. It has to be based on metrics. It can't just be me sitting here using my gut instincts and thinking, well, I think the market's going to do this, or no, I'm going to cycle out a short vol and move into gold. Gut instinct predictions are not going to be consistent long term. So moving between these positions, it requires the most robust volatility metrics underlying the strategy. If you are using something like the VIX Index, unfortunately, anybody who thinks, the VIX is the final boss, everybody's quoting the VIX in the financial markets, and now I'm really smart because I know what the VIX is. Sure, you know what the VIX is, but it is certainly not a leading indicator of anything. By the time the VIX actually tells you to exit to safety, the market might be down 7 or 8% already, and that's when it typically is going to start to bounce. You actually do want to pick up on these signals much sooner than the VIX will allow. The bottom line is, unfortunately, if you want to dive down the volatility trading rabbit hole with me, we are going to have to go quite a bit further than just the VIX index. Again, that's why I'm putting that volatility metrics course together. There's going to be about 15 videos there that you can actually break down each of these metrics in more detail. As I'm sure you've heard the quote several times, anything worth doing in this world is going to be difficult. The vast majority of people don't even get to the volatility metrics, and a good chunk of those few people that actually do, they end up stopping at the VIX. A lot of people ask me why my performance has been so good for so many years, 15 years of a great track record. Well, not to be too arrogant, I'm sure there's several reasons, but it's possible that one of them is that I didn't stop when things got hard. I kept going further down that rabbit hole, way past the VIX, and started to get to the actual metrics that really mean something in the market. Of course, if you've made it this far in this live stream, you're probably one of those people that want to join me down there. There's a lot of good information if you actually dig deep enough. That's what I'm here for. I'm the volatility guy. I'm here to help. Okay, let me catch my breath here. It's actually kind of funny. I mentioned that I almost didn't make it to this live stream. I was at Starbucks this afternoon just doing some work, and typically when I'm there, I might get some type of snack, a scone, a cheesecake, something, but I thought, well, I haven't had chocolate in a while, so stopped at the supermarket on my way to Starbucks and grabbed 2 chocolate bars, but not the regular size ones. I bought the 100-gram ones, so the 2.5 size. Wasn't planning on, it should probably last a week for a normal person, right? So I went to Starbucks and cracked the first one, and it was gone within 10 minutes. That's 500 calories. And then an hour goes by, and I'm kind of in my peripheral vision. I see the other one, so I started in on that one, and I quit before, there's like one single row left. So I had about 900 calories of chocolate. And so to punish myself, right after I sent my email today, I got my running shoes on and I went out for a really long run. So I got back to my house. It's Dubai here, so it's nighttime. I got back at 8:33 and the live stream starts at 9. So I showered, I turned all the camera gear on and frantically, made a coffee, rushed over here, turned all the lights on in 27 minutes after my run, just soaking wet. Of course, it's hot in Dubai after running. So yeah, that was pretty frantic. Let me catch my breath. You ever do that? I don't know if you're, I'm Canadian, grew up eating, Halloween, we used to use pillowcases. They have those little lanterns that normal kids are supposed to take and get a little bit of Halloween candy. We used to use pillowcases. So I try to stay as healthy as I can throughout my life, but man, sometimes I can just binge on stuff and, I think I'm going to be good. Oh no, it's enough chocolate for 5 or 6 days, and literally in 1 hour I ate it all. So, yeah, that's my life, I guess. I probably should have just stuck with the cheesecake. But let's go ahead and answer some of these questions. There's quite a few here. Like I said, I'm going to try to do more Q&A, less of the segments. And those segments, I'm going to try to just say the absolute minimum for about 5 attempts here. So gonna look at the analytics after I do 5 of these. I've already got the next ones planned, so don't be surprised if we're back here pretty soon. And yeah, let's start in on these questions. So if you have some, go ahead and fire them in. All right, how are you tracking the performance of the vol trend strategy during the time it's excluded from the total portfolio solution? Is it just flat? So yeah, great question. The volatility trend strategy for our portfolio was removed just this year. So last year there was 5 strategies with 20% allocation, and we had a UVXY broken wing butterfly strategy that had a 20% allocation. But I just felt like the market wasn't going to be fully conducive to that type of strategy. And at the end of every year, I do an audit of performance, I analyze the market. Everything I do is very systematic and quant-based, but I've got about 10 really viable, successful strategies, and I have to basically, as I always say, just put my starting lineup into the portfolio. And I only allow myself to do that hopefully once a year unless something really crazy happens. So at the end of the year, I decided, well, fall trend, maybe we won't do that to start 2024. But it's not in the portfolio now. So what that actually means, getting to your question, my performance, and this is super important, this is why I like how you asked this question. What most people do, and the reason why when you're looking out at performance on Twitter and on YouTube, everybody shows their performance and it always looks pretty exceptional. But what's actually happening is typically people will put some strategies in a portfolio, and let's say one of them really underperforms. Let's say it's down 30% and it's a terrible strategy. They remove it from the portfolio, and then they'll substitute something else in that they can show a really nice back test that maybe that one made 20% a year for 10 years in a back test, and they'll recalculate what the performance of the portfolio would be, and then they show that. And so this is called survivorship bias and backfill bias. So survivorship bias is when you're removing strategies after they've already failed, and then you're removing that performance. And backfill bias is essentially you're adding a strategy in sort of down the line, and then you're just assuming that it was there the whole time and you're backfilling that performance. So it's really important, and I always make a point to mention this, that everything I do has nothing to do with that. Everything you see with a total portfolio solution is only the email signals that go out to a paying community. So of course for me, let me find your question. Of course for me, I've still been trading this. I have many strategies going behind the scenes. But for the portfolio, none of that counts anymore, of course, because it's not in the portfolio. So yes, flat, basically. But I will still keep track of what I'm doing in my own personal spreadsheets, of course. I've been trading volatility trend, broken wing butterflies, since I removed it from the portfolio. And actually because, nobody can know this ahead of time, but actually because the market kind of fizzled out a little bit on the volatility, and it's actually been going down, I had, several weeks in a row of pretty easy wins there. If you know how the broken wing butterfly works, really the big risk is when volatility really crushes down hard. So we'll look at the UVXY. Actually, we'll look at it on a longer term chart. If you look at the UVXY, really the only risk to a broken wing butterfly would be something like this, like a really big flush down. This one here would be dangerous, but actually it's kind of been leveling off lately. So, you know, as it happened, I actually had some pretty easy wins. I mean, who could know that ahead of time? You just have to do the best you can. But so I'm tracking myself, obviously, but it will never be included in portfolio results. So let's say next January in 2025, or maybe sooner if I decide, I put it back into the portfolio. None of that performance when it was gone will be added to the results. That's not how it works. If it wasn't sent out to a real paying subscriber, then it doesn't count as performance, right? We did the same thing with the tactical volatility. It launched in January 2012. So just to give people a visual, this green strategy here launched in 2012. It was in the portfolio all the way until, I believe, February 9th, 2022. So, you know, 10 years, a little bit longer. And it was removed for a little while. And then it was entered back in mid 2023. So out of the last 12 and a half years, it was only in the portfolio for 11 and a half. But that 1 year missing, I know what the performance was on my end, but that certainly doesn't count towards my track record because those signals were not sent out to any actual paying subscribers. So that's how I've always done it. Every time you see my performance on the website for the total portfolio solution, that is the absolute live results, including trade fees and dividends and all that stuff. Now, I can also show individual strategies, what they would have done if it was there the whole time. And, you know, I don't know if you're ever interested, maybe come back, ask a question, I can show you those, but you won't ever see those on my website because that's not actual live trading. So be very, very careful about survivorship bias, backfill bias, and that is largely why you see pretty much every track record online when people show it to you. It tends to look quite impressive. And then as soon as you join, you kind of like, well, what's going on? It immediately failed as soon as I started. So that's kind of typically what's happening there. All right, thoughts on how VVIX can be used. VVIX is an interesting one where it sounds really geeky and cool. VVIX is basically the volatility of the VIX index, vol of vol, and it sounds really high level and everything, but it's actually quite a poor indicator. It's very hit and miss. There can be times when volatility is low and stable and you would have wanted to short volatility, and the VVIX is very low and it would have given you, you know, kind of a nice entry. But then there's also times it can be the opposite and you could totally miss it. So the only real use that I find for the VVIX, and it's not even really very useful for this, but if anything, like I'm reaching here, but if you see a market collapse, typically with the VVIX, you'll see the S&P 500 go down. You'll see the VIX index spike up really high. If it's a major crash, you're talking about the VIX going very high, like let's say in the 20s or the 30s or 40s even. The VVIX, there are times when it can be used as a signal to when the market might be getting a little bit exhausted of the selling. So if you see VVIX start rolling over and coming back down before, say, the stock market stops crashing or before the VIX starts coming down, that can sometimes be a signal that, you know, it doesn't go down forever, right? Obviously, there's going to be a pivot point at some point. People are going to come in and buy the dip. There are times when the VVIX can be used for that. But outside of just basically trying to potentially time a reversal, I would largely ignore it. Unless you're trading direct VIX options, then of course it has some application. But what I find is very few people are actually trading VIX options directly. Okay. Is this the same person? It's a similar question. How did your paused strategies perform in hindsight? What's your success rate in pausing the right ones at the right time? Good. Yeah, great question. So top of my head, I should actually try to do some accounting of that at some point. But top of my head, say let's just for the last 4 or 5 years, just assume that you've been here for a while. When we removed the tactical balanced, that was a very good timed exit. So tactical balanced had a monster year for us. And then I removed it because I felt like the MDY, that's what we were using. So we typically use the S&P 500, the NASDAQ, MDY. I have another strategy that uses the Dow, but that one was using the MDY, the S&P 400, right? So, you know, not the big companies like the Facebooks and Google and Tesla, you know. And I removed that pretty much at the right time. So the performance was significantly worse than the defensive rotation and the strategic tail risk. So that was a good one. What else? And then I guess tactical volatility was not a good. Well, actually, this is hard to say. So the tactical volatility strategy, like I said, was removed, I believe, on the 9th of February, but those dates kind of, I mean, it might have been the 14th, but somewhere around there. And it pretty much, that was 2022. And so it actually suffered about a 30% drawdown. And if it was left in the portfolio, we would have suffered that 30% drawdown as well. But because of the way the markets have traded, what ended up happening with SVXY was, let me try to find 2022. Yeah, like this. So it went down, and that would have been uncomfortable. And then it actually bounced pretty strongly. So what would have ended up happening is we avoided a 30% drawdown because I removed it, but then we didn't get back in time. Like we got back in sort of mid 2023-ish. So I don't know, somewhere around here. So we kind of, on a technical basis, we lost money, but I would, of course, you know my style, I would always prefer to avoid drawdowns and preserve that emotional capital, right? Not suffer that, oh man, we're down, 30%. Technically speaking, I removed it and we lost money doing that because the recovery in 2022 was pretty strong. That strategy was up 82% in 2023, and we only got part of that because we didn't re-enter until, past the second half of the year. So, there's that one. And volatility trend, I suppose you could say it's down a little bit on the removal, but like I said, I've only done maybe 5 or 6 weeks of it pretty strongly. So, maybe volatility trend is such an interesting strategy and people like it, on a just enjoyment perspective. And there's also a full course. There's like 12 or 13 articles, a couple of videos, and that's still available. I didn't remove that. So the course is still there. I probably could throw in like a optional at the very bottom of the email. I could start doing that again maybe. Or maybe just throw a single allocation back into the portfolio just to give people something more to do, right? Trend following can be boring at times. Like when you're making a lot of money like we have the last 6 months, it can actually be boring. I mean, it's great to make money, but there are very little trades going on when you're just riding the NASDAQ, you're riding the short vol. So I don't know. It's tough. Managing these things, I made the decision to remove it, and I don't know. How would it look if I put one contract or one trade layer back in? I don't know. I don't know if people would look at that and think, oh, this guy doesn't know what he's doing. I would only be doing it because I think people might actually want something to do week in and week out. So, perhaps I jumped the gun on removing it. I probably should have labeled it optional and kept them in there and just not count them for official performance. I don't know. Yeah, nobody understands how to trade the VIX or other volatility metrics. I missed your first comment, sorry. Using SVXY and uptrends. Yes, for us, we do. So essentially, obviously, there's many volatility ETPs. I've actually got a video coming out very soon here. I will be talking about the volatility landscape, just laying it all out for everybody. So, God, I'm clicking all over the place. I think just going on that punishment run, I'm still flustered a little bit. So yes, when we are in short volatility, let's highlight them all. I use the SVXY, so it's the minus 0.5 times inverse. Now, of course, there is the SVIX, which is a minus 1 times inverse, and we would never use short VXX or short UVXY. That's unlimited loss. You're not in control of your shares. There's massive fees involved. So we never short the volatility ETFs directly. That's always extremely inefficient, and it's much better to use the inverse products on the long side. And so we use actually the SVXY, and people ask me about this, but I actually really like it. I think that anytime that you can manage some of the risk just structurally within either the ETF itself, like SVXY, it's a little bit watered down, or with the strategy and just how it's all laid out, if you can eliminate some of that risk, it allows you to be much more aggressive. So my typical example that I would use is, let's say somebody's trying to short volatility and they have a choice between doing a tactical strategy with SVXY or selling naked UVXY call options, right? We're going to the extremes here. One is quite safe and protected. One of them is unbelievably risky. And, if there's a flash crash, you're dead. So what ends up happening is holding the SVXY is very efficient, and it doesn't even require the full margin. You can probably do 30, 40% margin on that. But if you're doing the UVXY naked call, first of all, the margin on naked shorts on calls is extremely high. So it's super inefficient right away. The second thing is that, of course, the risk is insane. So you have to only put a portion of your capital into it. And so you end up with a situation where the SVXY person can put all of their capital into the short vol trade and just have it half protected right away, and then look to exit positions when you need to move to safety. And the guy on the other side can maybe only put a third or a quarter of their money in it. It's already inefficient from a margin perspective, and you're only bringing in pennies every time you get one of those easy wins. So long run, it appears like the SVXY is the watered down strategy, right? On first glance, you're like, no, I'd rather just get all the juice of the UVXY. Well, as it turns out, if you just run the numbers on it long term, clearly the SVXY trader is going to make more money, because the goal of trading is not to make pennies on 20% of your capital. It's to get your full short vol allocation going as much as you can and capitalize on the trends when they happen, right? So the SVXY, while it appears to be watered down, is significantly more profitable than if you were to do one of the other very inefficient, very high risk strategies. So that's why we do that. As far as nobody understanding the VIX, I wouldn't say nobody, but not many. And I'm hoping to change that if people follow my work. I've started to get a little more active on Twitter. I don't know if people have noticed that. I should have a little card that I can just slap up there. But if you want to follow me on Twitter, it's @VolatilityVix. You can just search @VolatilityVix and you will find me. Do I have it here? It's possible that it's somewhere. There it is. I don't know if you can see. No, you can't, because I had that too small. I don't know if you can see that. There it is, @VolatilityVix. Follow me on Twitter. I'm putting out a ton of data. I'm pretty sure there's no one in the volatility space that shares even, a tenth of the data that I do on Twitter. So definitely follow. Okay. Oh yeah. Going running by canoe. I don't know if people saw the storm that hit here. It was insane. So I live part of the year in Taiwan and part of the year here in Dubai. And of course, Taiwan has typhoons, and they can be pretty scary, but I always kind of joke with my wife, like, I'll go outside and go running during a Taiwan typhoon. I've been there, when there's a serious one that you stay inside, but she assures me they're scary. But no, this storm that we had here, this building is super rock solid. Nothing, I don't hear a thing. It's a very well-built building. I was really worried that these bay windows were just going to get blown in. I mean, it was so loud. I had YouTube turned on. I was trying to watch a video, and I couldn't. I had to put earphones in. I had a computer max volume. The wind from outside, I couldn't hear my computer inside my house. That's how loud the wind was. And the flooding is just like, you see buses, underwater. It was insane. So fortunately, I don't really know how they do it, but it's 2 days later, and you go outside and there's some evidence that something happened, but not really. I mean, they're pretty good at cleaning things up here. I'm quite impressed. How did you survive? I stayed in. I didn't go running, although I did go out to the coffee shops and got stuck in one of them for several hours where they wouldn't let us leave. I went into the coffee shop kind of running under the rain, and it was okay, but it was bad weather. And then the storm really picked up while I was doing my work in there, and they closed it and they said nobody can leave, so yeah, that wasn't fun. Can you explain how volatility ETN providers make money? Well, I do mean like just the issuing bank, like ProShares and iPath. They basically just have management fees. So if you look on all the volatility ETFs, they have a management fee. So let's say it's 1.35, something like that for, I don't know, maybe VXX, 0.87, whatever they are for all of the products. And if they are managing $100 million, for example, well, there's your management fee. And it's just included, in the NAV value. So it's just part of our expense to hold these products. And that's how they make money. So there is obviously a hurdle rate where they have to have a certain amount of assets under management, or it's no longer going to be profitable for them to even have it going. This is why I suspect that ZIV was my old, sort of one of my absolute favorite products back when it was actually traded with decent volume. And then they relaunched a version of that called ZIVB. Last I checked, I think it's hovering around 3 to 4 million AUM. So they're definitely losing money on that one. I would not be surprised if the ZIVB is gone just about as quick as it came, unfortunately. But yeah, there's just hurdle rate. I think they have to. I'm not a real regulatory guy. I've never worked in the financial industry. I've never launched an ETF of any kind. So I'm just a trader on the trader side. So the back end stuff, I'm not the guy to ask. But I've heard that it costs roughly, around $250,000 just to manage an ETF. So if you can't recoup that in the management fee that's, built into the ETF wrapper, then no point holding it open, right? This is kind of hypothetical, but whenever you decide to retire, would you consider publishing the details of your strategy anywhere? This is going to sound incredibly self-serving, but obviously I'm always honest about the fact that the best I can offer people is a win-win for both of us, where what I mean is I make money doing this, right? Everybody who has subscription services and strategies that they're selling, they're doing it for money, right? If you ask somebody, why do you manage a subscription? I can give you 10 really good reasons why it's good for everybody, and I can help everybody around the world, and it allows me to educate, and I don't have to worry about compliance officers, and I can say what I want, and I can tell you the truth about things, where asset managers, you can't do this and you can't say that. So I can explain a whole bunch of reasons why it's really good that I do a subscription model, but at the end of the day, of course, I also make money doing it. So I do actually have another consulting business where it's called Prosperitas, and I also license my strategies out to other asset managers and hedge funds, family offices. And so from that perspective, I really don't think that it would be good for me to do that, to just say, look, I'm out, I'm not doing this anymore, I'm just going to release it on the internet. There is actually other people using those strategies right now, so I'm not sure how that would go. And to be perfectly honest, again, I don't shy away from the fact that I like money. It would actually be a pretty reasonable opportunity to just sell them, right? I mean, would I give them away for free? I've had people offer, you'd be surprised how much money I've been offered for my strategies. And I always turn it down because I like what I do. I mean, I like doing live streams and videos, and it's part of my life. It's just, I don't know what I would do with myself if I wasn't doing this work, but they are actually worth quite a bit as well. So not to bring money too much into this, I really do. Like I said, best I can offer you is a win-win. Most of the garbage that you see out there, they make money, following along or buying the course or, listening to their advice. They lose money. So that's a win-lose. Best I can offer is this is definitely a win-win. People who follow my work profit from it. And of course, I get paid for my work. So no guarantees, because I do have Prosperitas Asset Management as well. And not exactly sure how that would work with the, non-disclosure agreements and all that stuff. I would have to check with a few of them. Not sure they would appreciate that. Looking at the VIX futures term structure, the futures are in contango, so no real disaster being previewed by the market participants. But VIX is actually higher than first 2 months. Your interpretation, please. So I suspect, and this is very good, let's move that around. What you're getting at here is extremely important if you're going to be a volatility trader, successful volatility trader. There is a massive difference between contango and roll yield. One of them is useful and one of them is not. So contango is simply, is this M2 future higher than this M1 future? This is what we call contango. So right now, as you said, it is in contango, 2%, as you can see right there. So 2% contango, you could say, well, the market's not pricing in any fear. The long-term median is about 6, so it's significantly below the long-term median. I would say that is pricing in fear. You got to remember that Contango is about 84% of the time. So this is not a 50-50 line we're talking about. It is most of the time in Contango. So 2.01 Contango is considered low. That's the first thing I would say. But Contango is totally useless. This is not how the volatility ETPs get their pricing. A lot of people think that, oh, because VXX, it sells this one and buys this one, and because this one's really expensive and this one's really cheap, when you're churning this over and over every single day in this daily rebalancing, it must be losing value. That must be what's happening. And a lot of people perpetuate this. They say the words, you know, buy high, sell low. They talk about this, but that's not actually what's happening. You have to imagine that all the rebalancing for these volatility ETFs are done at a net zero transaction. You're literally just moving money from one spot to the other. They're just selling front month futures, getting a certain amount of money for that, and then they're putting that exact amount of money into the second month futures. So the number of futures they're buying and selling are different, but it's the same dollars. You're just literally moving money like this. You're not losing any money when you're moving it. You can sell, if you have $10,000 in Apple, you can sell it, get your 10,000, go buy Tesla. It's a totally different price, totally different share count. You still have $10,000 in Tesla, right? You didn't lose any money by moving your money from one thing to the other. What ends up causing the change in NAV value is what we call roll yield. Roll yield is the relationship between the front 2-month VIX futures in comparison to the spot VIX price. The reason this is important is you can see here, if you highlight, it says 33 days. So we are starting the next cycle, and this is actually a long cycle, this May cycle. So in 33 days, no matter what happens in the market, VIX futures are freely traded, and the VIX index is calculated based on S&P 500 options. So these things can go all over the place. But in 33 days, this dot will be exactly the same price as the VIX. So that's what happens. It converges towards the spot VIX at expiration. This is called roll yield. This is the valuable information. The contango means nothing. That daily rebalancing means nothing. Right now, there is a headwind for the VXX, right? Or the short vol trade. Because of this, it's actually below the VIX index. So all else being equal, these will tend to go up towards the VIX as we approach expiration. This is what's actually causing that change. If we go back to my Apple Tesla example, moving capital from Apple to Tesla at the end of the day does nothing to the value of your investment account. You lost no money, you gain no money. When you gain or lose money is what happens to your new Tesla shares the next day. That's going to change your portfolio value. But just moving futures from one to the other, nothing happened. So you are correct that the VIX futures are saying no real disaster. Remember, they are actually about the 80th percentile right now, or the 20th percentile. So they are actually signaling something. But yes, always focus on roll yield. Don't even pay attention to contango. It's just kind of like a low-hanging fruit thing, kind of like the VIX, right? A lot of people write articles about the VIX. I just demonstrated that the VIX is not an indicator of much of anything, but it sure gets a lot of eyeballs. And when you talk about contango and backwardation, that gets a lot of eyeballs, but it's unfortunately quite meaningless with the pricing of these products. That was a really long way of saying focus on roll yield. It seems most of the, let me check the time. I swore I was going to, I'm doing pretty good. 43 minutes in. It seems most of the tactical strategy have safety positions which are interest rate sensitive. I like where this is going. I think there's a fine line for credit events like 2008 and COVID. Yes, this is one of the things that we are battling with in the last several years. If you've been following my work or pretty much any tactical trend following strategy, what happens to your performance when the safety positions are no longer acting like safety positions? All right, so in the tactical volatility, we use gold. In our defensive rotation strategy, we use utilities, and then our extreme position is cash. But essentially, our safety is utilities. And then in the strategic tail risk, where are you at? Here we go, strategic tail risk, we're using IYR. But in the past, we were using TLT until I removed that because the Fed signaled they were probably going to be raising interest rates. So we got out of the TLT in time. But yes, IYR definitely has an interest rate component to it. It's not directly, it's not like bonds where there is quite a literal relationship. But yeah, there's actually a component there. And certainly you could argue the similar thing in utilities. So what is safety these days? Our portfolio, when it is in safety, that's what it looks like. Let me move this out of the way. Our tactical volatility safety, we are currently in gold. Our defensive rotation, we're currently in utilities. And our strategic tail risk, we are currently in the IYR. And then iron condors are there to make money when the market doesn't really move. It just chops around sideways, doing not much of anything. But our safety is what it is. Now, for the first 10 years of my portfolio, from 2012 to 2022, of course, safety positions performed very well. So the trend following was awesome. Short vol made a killing. Back then we were using MDY and SPY, but they were all doing extremely well. So everything was kind of going fine. In the last 2 or 3 years, what is safety these days? They're not acting like safety positions. And you hinted on it. It's because they have a interest rate sensitivity to them. What are you going to do, right? They are still slightly better than cash, but not much better, right? In the past, they were significantly better than cash. But now we're just not getting any performance out of these things. This latest turn we did, which, I don't want to jinx anything, but we moved out of short vol and into gold, and gold immediately performed well. And we moved out of the QLD and into XLU. And the very next day we did that, the QLD was down 2% and utilities were up 2%. So we've actually won about 5% gain, net in the tactical vol and about 4% in the defensive. It doesn't always work out that way. Sometimes you shift out and the safety position immediately fails you and the other one you left is actually doing well. Long term, law of large numbers. But it was actually kind of cool just this week to see, it wasn't so terrible when we switched those positions. It can sometimes be frustrating. But yeah, I feel you. It's a tough market. It's not so much a tough market for the trend following, for the short vol, for the or for the stock market, S&P 500. Trends are decent still, but yeah, what do you do at safety? 2022 was a nightmare. I mean, bonds had a 51% drawdown. Utilities were down. Real estate was down. Gold was down. Every single asset was down just as much or more than the stock market. Emerging markets down. What do you do? If there's no safety, well, strap in. You're going to have a 20 or 30% drawdown. That's what it meant. And for us, we had a 25% drawdown. We lost 20% that year. What are you going to do? We're in utilities, real estate, gold. They're all down. Not much I can do. I hope safety positions start normalizing. I would love to know this, but I ask no questions about new subscribers at all. I don't even send out a questionnaire. I've had people mention, hey, you can ask us. I don't like to ask personal questions. People volunteer sometimes. They'll sign up for the subscription. They're really excited. They want to meet me, so they give me an introductory email. They tell me what they're at and their goals, how old they are, what their jobs are. But I don't ask any of that, so I wouldn't know. I've had people email me and say that they're trading $20 million, which shocked me when that guy told me that he was trading $20 million account. He's like, these iron condors are killing me. I'm trading at $18 million or something, he said. I was like, yeah, you got to start using the SPX options, my friend. That's the SPY options are going to kill you on iron condors that size. So, but then I also have a bunch of people email me. They might say, well, I've got $5,000. Can I follow your strategies? And I don't know. I don't know. I know how much my strategies are running in the family offices and the hedge funds out there, but I don't have any information about my subscriber base, unfortunately. I just don't want to pry. I think that your account size is your business. I think once you clear about, on the really low end, of course, like with anything in investing, the more money you have, the more efficient it gets, right? As I always say, technically speaking, you could follow it by buying a single ETF share. But the difference in performance with holding one share and churning one sell, buy, sell, one share versus two shares, this is an insane gap, right? There's no efficiency at all. Whereas if you go 99 shares versus 100 shares, you're not even going to really notice the inefficiency at that point. So more the better. But once a person crosses, 5, 7, 8,000, it should be efficient enough. And then, of course, just keep living below your means, keep trying to boost your income, stuff as much money as you can in your trading account every single month, and you'll get there. Okay. What do you think about the weird volume spikes on the VIXM? Market making related? I have no idea. I haven't watched. We don't hold the VIXM that often. So VIXM is our safety position for strategic tail risk. It only flags about 3% of the time. So volume spikes, you say, on VIXM. I don't know. Now, one thing I will say is that a lot of times people will comment that VXZ, which is one of our long vol options for the tactical vol, and the VIXM, these are midterm futures long volatility products. So they're essentially VXX moved out on the term structure. A lot of people comment that the volume is quite low, that they're only managing, 40 to 70 million AUM. But the thing you have to always keep in mind is the time when that volume ramps up is when the market is struggling. When the market is crashing, that volume in those ETFs will ramp up, and that's when we will be holding them. So volume and liquidity, it does mean something different in the volatility space. So you don't technically have to worry too much about low AUM. Like 50 million is absolutely fine. There's share creation, there's share redemptions, there's authorized participants. It's not the same thing as a low float stock, for example. Volatility ETFs actually trade pretty well that way. But you don't have to worry about it anyway, because the only times we're ever actually holding those is when the volume is going to spike up. So maybe that's what you're seeing. I don't really pay attention to the volume of it, but markets have been down, so perhaps that's what it is. Maybe people just rushing for some large block hedging, and it just, because it's such a low traded stock or ETF already, it's actually quite visible on the volume when somebody comes in with a big block of purchase. Maybe that's what you're seeing. Any thoughts on high dividends yields ETF? Are you trying to rile me up? Because I've gone on several rants about dividends. I don't know if people want to hear me go through all this stuff again. What I will say about this is dividends are one of the most misunderstood aspects of the investment world, I find. For whatever reason, and I'm sure it has a lot to do with social media and Twitter and TikTok and all this garbage that people put out there, for some reason, people think that dividends make them money. And I just don't even know how many times I have to tell them, but that dividend comes directly out of the value of the company. So when you get paid a dividend, I hate to break it to you, but the stock price is reduced by the dividend amount and you didn't make any money. It is just literally, it's kind of like the other example, just moving money from one category to the other. Let's say you have $100,000 value of a stock and they pay a dividend worth $1,000. After the dividend is paid, the stock price goes down, you will have $99,000 value of the stock and you'll have $1,000 cash in your account. That's what it is. So unfortunately, and I think one of the reasons people don't know this is because dividends are typically quite small. They're typically paid quarterly, and they're typically, let's say, in the 4% range. So 1% quarterly dividend, you can't even see it on a chart. But if you go look at something like a special dividend, you will see it just chunk downward, right? Of course, that dividend, because anybody who buys the stock after the dividend is paid, they're not privy to that value in the company. They don't get that bonus, right? So of course, on the exchange level, it has to be removed from the company. You just paid out cash out of your book value of your company. Well, that's gone. You don't get that back. So the dividend goes into the ether and everybody takes their cash. The stock price drops. And, dividends don't actually make people any money. You can also see it if you look at these, money market funds, for example, where they're paying a coupon rate. And because it's typically on a chart, you can see it doing this on a long-term chart. What's happening there is it's building up when it's trading, it pays a dividend, it chunks down, it builds up, it goes down, builds up, and the slope of the line might be going up 2% because maybe it's a 2% coupon rate, but you can see the thing chunking. So honestly, what's my thoughts on dividends? Ignore them completely. If you see a dividend, just look past it. It's nothing. But that doesn't mean that some dividend stocks aren't good companies. But of course, you should focus on the company itself, right? Like NVIDIA, I think the dividend is like, 0.00, whatever it is. It's basically a non-dividend stock. Obviously, NVIDIA is better than Coca-Cola, right? It doesn't matter if Coke pays a dividend. You don't get any cash when you get you get cash, but then you lose stock. So obviously, you'd rather hold NVIDIA and then just pay yourself a dividend. Just sell a couple of shares every couple of months and pay your own dividend. I'd rather have a good company than a dividend-paying stock, right? So there are some times when a dividend-paying stock is actually a good company, but there are plenty of times when, because it pays a dividend, what they're essentially telling you is, we have no other ideas for this money. Like, we don't know what to do with this cash. We don't have any R&D ideas. We don't want to launch a new division in our company. We don't want to go out and buy out some small competitor and bring them into our firm. We don't want to buy any software or any extra tech. We don't know what we're doing with this money. So let's just throw it out there in a dividend and people will, get all giddy that they think they're making cash. I would rather a company say, no, we've got a lot of great ideas for this cash on our balance sheet, and we're going to keep it in the company. So that's just my opinion personally. I just think it's one of the most misunderstood subjects in the world for some reason. And you see TikToks like, I made $20,000 this year on dividends. Nope. You got 20,000 cash and you lost 20,000 stock value. Congratulations. But TikTok's funny. Facts don't matter on TikTok, do they? All right. But maybe your question was a little bit different. Where's your question? Maybe your question was something like the SPHD, the high dividend yield S&P 500 ETF. Maybe I just went on that whole rant and you weren't even asking me about that. Maybe you were asking me, is it valuable to consider something like the SPHD as opposed to the SPY? In that respect, maybe yes. Because even though the absolute return is actually lower, right? This is what you'll find with dividend-paying stocks. The long-term return is lower, so don't focus on dividend stocks. They're actually worse. But they can be smoother. They can reduce drawdowns. And the reason for that might be dividend yield. If a stock is crashing, one of them pays a dividend and one of them doesn't, market participants, every time the stock goes down further and further, that dividend yield is becoming more and more attractive. And it's possible that market participants might come in and buy the dip a little sooner on a dividend stock rather than a normal stock. So long-term, dividend stocks are worse, right? You're not making any money. You're actually taxed on the dividend if it's not in a tax-sheltered account. It's worse across the board. And the company's telling you we have no ideas for this money. So dividend stocks are typically a poor idea. But for a tactical investor like me, if you're moving into a safety position, buy and hold S&P is better than buy and hold SPHD. But safety position in the maybe 60 to 90% volatility range, better performance of SPHD than you get for the SPY. So if that was your question, that's different. They can serve a purpose as tactical positions. This is why I actually did a live stream about a month ago highlighting the fact that while Coca-Cola itself is not a good company to hold because there's a million non-dividend stocks that are far superior to Coke, but as a safety position, because of that dividend yield and the fact that it's actually quite a consistent stock, it serves as a better safety position than the stock market does. Maybe that was your question. I'm reading a lot into this. Hopefully somewhere in there was an answer that is satisfactory. Did you mention a link to the trial offer? I did. top of the stream, the very first one. There's a free trial link there. Everybody can take it. I will not be offended at all if you take the free trial for 2 weeks and you decide it's not for you. I would appreciate you taking a look at our work. And if it's not for you, then just be on your way and we will part as friends. All right. Family office uses only one broker or use a few to distribute. I don't get into it. I am a consultant only. So I don't have a whole lot of information on that end. They don't share that with me. They typically give me a little wink, wink. Here's how much your strategies are churning of our AUM, but that's about it. So this is an easy question. I can answer this in about 10 seconds. What's your philosophy of life? All right. That sounds like a novel. You got to be more specific, my friend. Philosophy. I have a lot of philosophies of life. I live an interesting one. A lot of people, when they find out what, I don't share much, but I'm an open book. If you ask me questions, go ahead and ask me questions. But when people learn kind of what I'm up to with my life and what I've been doing for the last 30 years, from, you know, going to a couple different universities, playing professional golf, traveling around the world, you know, digital nomad for 17 years, lived in many different countries. And, you know, I've had a lot of experiences. I've had a lot of ups and downs and, you know, health scares and, you know, cancer and, you know, just had an interesting life. So I've got, you know, probably a philosophy that might be a little bit odd to some people, but ask me anything specific, I'll answer it. All right, questions are done. So let's see if we brought it in under 1 hour. 1 hour and 1 minute. So that's pretty good. I consider that a success, especially since I very nearly didn't even make it to the live stream. So I'll try to consume less chocolate. I won't have to punish myself on the runs. And like I said, don't be surprised if I'm back soon. I don't actually want a schedule because sometimes when I'm in the zone with my work, I don't want anything to interrupt me, including this one, including my wife. Sometimes it's just, I mean, just don't even, just I'm in my bubble. And so I don't typically set times for my live streams. But I'm thinking early next week we'll do another one because I've got a couple of topics. In the meantime, there might be a few people left, so do me a favor. What I want you to do is go to my YouTube channel. I'm probably going to jump in here and say something. Watch this video. If you haven't seen it, watch this video. So it's watch this VIX metric crush the S&P 500. In this video, I showed how the VX30 to VIX roll yield metric, this one, can be used to filter for short volatility signals and crush the market. And I put out that video and people appreciated it. They liked the video. But a couple people, and I was very proud of the VTS community, a couple of people mentioned that I actually used a look forward bias on that video. And I love that because I did, but it doesn't affect the results. But I'm actually going to do a live stream next showing you the results if you go through the really long form of filtering it out with no look ahead bias and just using the things that you have. I think people will be interested in that one. So early next week, that's definitely what we're going to do. So thanks everybody for tuning in. Give it a like on your way out the door. For some reason, I always say that at the very end instead of the beginning. So don't know why I do that. I'm terrible at YouTube, but I will see you next week.